If you looked at your trading terminal this afternoon, you saw a number that was mathematically impossible. You saw silver trading at $72.15 in New York. But if you were a manufacturer in Shanghai, attempting to procure that same metal for immediate delivery, the price was $84.55. In a functioning global economy, a $12 spread on a fungible commodity like silver shouldn't exist. According to the efficient market hypothesis, arbitrage traders, the immune system of the financial world, should have closed that gap within seconds. They would buy in New York, sell in Shanghai, and pocket risk-free billions until the prices converged. But today, the gap didn't close, it widened. The arbitrage is dead because the mechanism of global trade has broken. We are currently living through a historical anomaly, a bifurcation of reality where the paper price of an asset and the physical price of an asset have stopped speaking to each other. The date is December 31st, 2025. And in exactly 36 hours, the world changes. We are standing at the precipice of a structural shift in the global monetary order. To understand the gravity of this moment, we must look beyond the red and green candles on a chart and understand the mechanics of the deadline we are approaching. It is New Year's Eve 2025. While the world prepares for celebrations, the global financial plumbing is under immense strain. We are exactly 36 hours away from the implementation of the China export ban. When the sun rises on January 2nd, new laws go into effect that effectively seal the borders of the world's largest manufacturing nation. The flow of silver, a critical strategic metal required for everything from advanced weaponry to solar energy infrastructure, will stop leaving Chinese ports. Markets are forward-looking mechanisms. They usually price in events months in advance. However, what we have witnessed over the last 48 hours is not a pricing in, it is a breaking point. The market has fractured into three distinct tiers, effectively creating three separate realities for the same element. Tier 1 is the Shanghai reality. This is the panic price. The Shanghai Futures Exchange closed its final session of the year at an equivalent of nearly $85. This is the price paid by the entities that actually consume the metal, the battery manufacturers, the solar giants, the state-run strategic reserves. They are desperate. They are front-running the ban, paying whatever is necessary to secure inventory before the regulatory doors lock. Tier 2 is the physical reality, centered in the Middle East. In the souks of Dubai and the trading hubs of the UAE, we are seeing transaction prices averaging $79.61. This is the honest market. It is not under the immediate legal threat of the Chinese ban, but it is reacting to the scarcity. It tells us that even in a neutral jurisdiction, physical silver commands an $8 premium over the paper price. And then, we have Tier 3, the New York reality. This is the price you see on CNBC. It is currently hovering at $72. This represents the zombie price, a valuation based on paper contracts that are increasingly detached from the physical supply chain. The spread between New York and Shanghai is now 17.2%. I want you to pause and consider the implications of that number. In the world of high-frequency trading, a spread of 0.5% is considered an arbitrage opportunity of a lifetime. A spread of 17% is an indication of systemic failure. The reason the banks and hedge funds are not closing this gap is simple. They cannot move the metal. They know the January 2nd deadline acts as a hard wall. If they buy paper contracts in New York today, they cannot take delivery, clear customs, and land that metal in Shanghai before the export licenses activate. The bridge between West and East has been burned. New York has become an island of paper trading, stranded in a rising sea of physical shortage. The COMEX, the primary futures exchange in the United States, is no longer the price setter. It has become a lagging indicator. The real world, the world of factories and supply chains, has decided that silver is worth $85. The paper market is simply the last place to admit it. While the price discrepancy draws the headlines, the real story, the one that keeps risk managers awake at night, is volume. Price is a signal, but volume is the truth. We have just received the preliminary delivery data for today's trading session on the COMEX, and the numbers suggest a violent contraction in liquidity. To understand this, we have to look at how these markets typically function. In a normal trading month, billions of ounces of silver are traded on paper, but very few traders actually want the metal. They are speculators. As the contract expiration approaches, they roll their position forward to the next month. They sell the expiring contract and buy a future one, never touching a single bar of silver. Yesterday, that pattern held. Only 69 contracts stood for delivery, roughly 345,000 ounces. That is standard operating procedure. But today, the pattern shattered. The number of contracts standing for physical delivery exploded to 1,147. Let's run the math on that. One contract represents 5,000 troy ounces. What 147 contracts equates to roughly 9.2 million ounces of silver demanded in a single day. Compared to yesterday, that is a 26-fold increase in physical demand. This is not a gradual uptake. This is a raid. Nearly 2,000 large entities, industrial conglomerates, family offices, perhaps even sovereign wealth funds, looked at the calendar, saw the impending export ban, and simultaneously hit the deliver button. They are cashing out their chips. They are no longer willing to hold a paper promise from a bank. They want the bars in their own vaults. This behavior reveals the logic of the short squeeze. These buyers realize that if they can force delivery at the suppressed New York price of $72, they instantly own an asset that is valued at $85 in the real world. They are effectively buying dollars for 85 cents. It is the trade of a lifetime, provided you can actually get the metal out of the vault. And that is where the banking system begins to buckle. The entities on the other side of these trades, the bullion banks like JP Morgan, Citi, and Bank of America, are the short sellers. They sold the contracts assuming the buyers would roll them forward. Now they are legally obligated to find 9.2 million ounces of silver immediately. They are caught in a liquidity death spiral. They have two bad choices. Choice A, they deliver the metal from their own vaults, but their eligible inventories are already running critically low, and depleting them further just days before a global supply crunch is suicidal risk management. Choice B, they go into the open market to buy the metal to satisfy the delivery. But where do they buy it? If they go to Shanghai, they pay $84. If they go to Dubai, they pay $79. They sold the contract at $72. This means they are locking in a massive loss on every single ounce. They are buying high and delivering low, which burns a hole in their balance sheet instantly. This creates a cash crisis, and this explains the anomaly we observed in the Federal Reserve's operations this afternoon. Usually the repo markets, the overnight lending markets banks use to fund their operations, are quiet on New Year's Eve. Banks want to close their books. Yet today, the Federal Reserve executed a second emergency repo operation. Yesterday, the Fed injected $3 billion. Today, they injected another $2.8 billion. That is a total of $5.8 billion of emergency liquidity pumped into the banking plumbing in 48 hours. To put that number in perspective, $5.8 billion is enough to purchase nearly 80 million ounces of silver at current prices. The banks are burning through this cash not to expand, but to stay solvent. This liquidity is the cost of the spread. It is the price the Western banking system is paying to keep the settlement mechanism functioning for another 24 hours. We are hearing whispers from trading desks that major banks have quietly increased loan loss provisions for their commodities divisions. JP Morgan reportedly set aside an additional $400 million overnight. In the language of accounting, you do not provision $500 million for a rainy day. You provision it because the storm is already stripping the roof off the building. We are seeing reports of administrative delays. Clients asking for physical withdrawal are being told it will take weeks, not days. Administrative time is banker code for we do not have the metal, and we are scrambling to source it. While the liquidity crisis plays out in New York, a far more permanent shift is occurring in Shanghai. This is the layer that mainstream financial news often misses because they are focused on currency, not resources. We need to talk about the vault drainage. The speed at which physical silver is leaving the Shanghai Gold Exchange has accelerated from a vacuum operation to a total depletion event. Yesterday, 41 tons of silver were withdrawn. Many analysts assumed this was a one-time strategic allocation. They were wrong. Today, the Shanghai Clearing Report confirmed an additional withdrawal of 43 tons. That is a total of 84 metric tons, roughly 2.7 million ounces, removed from the exchange in 48 hours. Historically, daily withdrawals hover around 2 or 3 tons. We are currently witnessing a 1,400% increase in physical offtake. This is not industrial consumption. Factories do not suddenly require 14 times more feedstock overnight. This is strategic hoarding. The inventory at the Shanghai Exchange has crashed to 727 tons. At this burn rate, the exchange is mathematically on a trajectory to hit zero in less than a month. However, markets never go to zero in a straight line. They snap. When inventory drops below a psychological threshold, likely around 500 tons, panic buying accelerates exponentially. Who is taking this metal? It is not retail investors. You do not move 84 tons of silver in a Toyota Camry. This is the state. These are the battery conglomerates like CATL and BYD. These entities have inside information regarding the strictness of the coming export licenses. They are engaging in preemptive logistical capture. They are securing the atoms before the politicians secure the borders. Every ounce that leaves the Shanghai vault is an ounce that is permanently removed from the global float. It can never be arbitraged back to London or New York. This hoarding mentality has trickled down to the corporate level, fundamentally changing the philosophy of global manufacturing. For the last 20 years, the world has run on just-in-time delivery. It is an efficient system where factories hold almost no inventory, relying on supply chains to deliver materials exactly when needed. Today, just-in-time died. We have received credible reports that Samsung, one of the world's largest consumers of silver for electronics, has executed emergency procurement orders to secure 6 months of supply. They are moving from just-in-time to just-in-case. Tesla's procurement division has reportedly labeled silver inventory levels as critical, authorizing purchasing managers to pay whatever premium is necessary to secure immediate delivery. When a company like Tesla ignores the spot price becomes irrelevant. Why are they doing this? Because the cost of silver is a fraction of the cost of a finished electric vehicle or a smartphone. A $10 increase in the price of silver is negligible to Apple or Samsung. But zero silver means zero production. That is bankruptcy. This corporate panic explains the disconnect in the retail market. If you try to buy a silver eagle coin today, you are not paying $72. You are paying $84, a $12 premium. Notice that number? It matches the Shanghai price exactly. The street price and the Shanghai price have converged at $84. The only outlier left is the paper market in New York. The premium is no longer a surcharge. It is the real price. The market has repriced silver. The paper exchange just hasn't updated the scoreboard. So what happens next? We are entering the final 36 hours before the ban becomes active law. We are currently in Phase 1, the last train. The markets are about to close for the holiday. This is the final window of liquidity for the shorts to cover and for physical buyers to position themselves. Once the closing bell rings, the liquidity train leaves the station. Tomorrow, New Year's Day, is Phase 2, the void. The markets will be closed. The screens will be dark. But this will be the most stressful day in the history of modern bullion banking. Behind closed doors, risk managers will be assessing the damage. They will be looking at the 84-ton hole in Shanghai and the 9.2 million-ounce delivery demand in New York. They will realize that when the sun rises on January 2nd, the math does not work. This leads to Phase 3, the repricing. When the markets open on Friday morning, January the 2nd, the export ban will be active. The arbitrage will be formally impossible. I anticipate we will see a gap up of historic proportions. The New York paper price will attempt to teleport to meet the physical reality. We could see the price open at 78, 80 or higher in seconds. But the price is not the danger. The danger is a declaration of force majeure. Watch for notices from smaller bullion dealers and perhaps even mid-tier suppliers stating that they cannot fulfill contracts due to unforeseeable circumstances. Force majeure is the legal escape hatch for a default. It is the polite way of saying, "We sold you silver we do not have, and now we cannot get it." They will offer to settle in cash. They will offer to give you your $72 back. But in a resource-starved market, cash is a poor substitute for the asset. This is where the lawsuits begin, and where the paper market loses its remaining credibility. We are witnessing the final transfer of wealth from those who trust the paper representation of value to those who demand the value itself. For decades, the financial system has prioritized leverage, liquidity, and speed. It assumed that commodities were just numbers on a screen, always available, always flowable. That assumption worked as long as global supply chains were frictionless. But the friction has returned. The borders are closing. Do not look at the red candles on a chart and feel fear. Look at them and understand that they represent a system trying desperately to maintain an illusion that has already been shattered by physical reality. You are holding the asset that Samsung needs, that the solar industry requires, and that the world's second largest economy is hoarding. You are holding the asset that cannot be printed by a central bank and cannot be defaulted on by a futures exchange. The era of paper pricing is ending. The era of strategic resource possession is beginning. The 36-hour countdown is running. In the end, this isn't about markets going up or down. It's about who understands the difference between a promise to pay and the payment itself, and who doesn't. This is the Currency Archive. We will see you on the other side of the gap.